Hi everyone. In today's video, I'll be walking you through question 4 from the May-June 2024 paper 2-1 for accounting. This question covers some really important topics like accruals and prepayments, disposal of non-current assets, capital versus revenue expenditure, and ratio analysis. This isn't just for Cambridge students. If you're studying accounting and need help revising any of these topics, this video will be super helpful. So let's get started. Here's the first part of the question. The question says Ahmed owns a trading business. He prepares his financial statements to 31st December each year. So that means the financial year ends on the 31st of December. Ahmed had some unused office space and he decided to use some of this to store inventory and to rent the rest to Bilal. On 1st January 2023, Bilal started renting the office space from Ahmed. So Bilal is the one who is renting from Ahmed. So Ahmed is the one who is letting Bilal use his premises. So basically, Bilal is the one who is paying the rent, Ahmed is receiving the rent. The annual rental charge is 4,800. During 2023, Bilal paid the following amounts of rent into Ahmed's bank account. So the payments for the period is given. So there was a payment done on 1st of April and on the 30th of September. And part A, we are supposed to prepare the rent receivable account. So rent receivable means in Ahmed's perspective. So Ahmed is the one who is letting Bilal use the office space. So first of all, we can start with the payments received by Ahmed from Bilal. So when you receive money, the amount in the bank account will increase, and bank is an asset. So asset increasing means you debit the bank account and you credit the rent receivable account, which is an income account. So over here on 1st of April, so this is the rent receivable account, you will credit saying bank 3,600. Similarly, the same entry with 2,400 on the 30th of September. Then that's not it. We also have to make an adjustment. So these are the payments received by Ahmed. We don't know whether this full amount is relevant or not for that period. So the annual rental charge is 4,800. We can record that. That is what goes in the income statement. That is what is relevant for that particular year. So on the 31st of December, which is the end of the period, 2023, income statement amount is 4,800. So if you calculate the totals, the debit side total is 4,800. The credit side total is greater. Credit side total is 6,000. So actually, Ahmed received 6,000, although the annual rental charge is 4,800, which means that Bilal overpaid. Bilal has paid more, which is a prepayment of an income because it's rent receivable. Prepaid income is, remember, it's a payable, it's an other payable, because Bilal, which is a receivable, has paid more than what he is supposed to. He has prepaid, which means we are liable. We, as in Ahmed, is liable to Bilal. So it is a current liability. That means we will have a credit balance brought down. So we can try balancing and see if it's right. So then 6,000, you transfer the same amount to the debit side and try to account for the difference, which is 1,200, which will be the balance carried down on the 31st of December 2023. And the balance brought down, as I said, is in the credit side because it's an other liability, because it's income prepaid, 1,200. So with that, we are done with part A. We can move on to part B. Part B says Ahmed sold old office equipment for 1,350 on 3rd January 2023 on credit to Rahat. The equipment had been purchased for 3,200 on 1st January 2021. Ahmed charges depreciation at 25% per annum using reducing balance method. He does not charge depreciation in the year of disposal. So there is some information given. The simplest thing, my advice for you when you get questions like this is to draw a timeline. So if you draw a timeline, we have these dates, 1st of January 2021, the date on which the asset was bought, and then the next year is 1st of January 2022, and then you have 1st of January 2023, and that year ends on the 31st of December 2023. That's done. Now, as the asset was purchased on 1st January 2021 and it was sold on 3rd January 2023. Now with the timeline, what we are going to do is we are trying to calculate the depreciation, the accumulated depreciation. So we have one full year between 1st January 2021 and 1st January 2022. Therefore, we calculate the depreciation for that year. And for the next year as well, from 1st January 2022 to 2023. But the question says that he does not charge depreciation in the year of disposal. So disposal occurs on 3rd January 2023. So we do not account for depreciation in the next year. So to calculate the depreciation for the first year, we simply multiply the percentage by the cost of the equipment. So 3,200 times 25% is 800. But for the next year, we use the net book value because it's reducing balance method. So we deduct 800 from the 3,200, which was the original cost. And from that, we calculate 25%. So 2,400 times 25% is 600. And thereafter, we won't be calculating depreciation. So the accumulated depreciation for office equipment is 1,400. Now, we have the values. Now let's try to recall what we would do when we are disposing an asset. So generally, we have these 4 accounts. So I've used the receivable account instead of the bank account over here because the question clearly states that the asset was sold on credit. That's why we have a receivable account instead of the bank account. And we have office equipment account, provision for depreciation of office equipment account, receivable, and the disposal account. Office equipment account will have a debit balance because it's an asset. Provision for depreciation account, it's a contra asset account. The asset value will be decreasing as an asset depreciates. That's why it's in the credit side. So that's a general balance that's given in black. When you dispose an asset, you will have to remove that asset from the cost account, asset at cost account. So to remove it, we will be using a credit entry. And if you're crediting the office equipment account, you should have a debit for that credit entry because we use double entry. The dual aspect concept applies. Then we will be debiting the disposal account using that same amount. Similarly, we should remove the accumulated depreciation for that disposed asset. So to do that, we will be passing a debit entry in the provision for depreciation account, and the opposite account will be disposal. And we know that the asset was sold on credit. So that means that we will be receiving money and the receivable is an asset account. So then we will be debiting that. The opposite account will be the disposal account, which will be credited. After that, you can balance and try to calculate the loss on disposal or the profit on disposal. So let's figure that out using the question. Right. So we have the values here. We know the accumulated depreciation and all that. Now we have to enter these values in the account. So the cost of the equipment should be removed from the office equipment account. So on the 3rd of January, saying office equipment, we will be debiting in the disposal account. And then accumulated depreciation of 1400, we will be using a credit entry in the disposal account on 3rd January 2023, provision for depreciation 1400. Remember, the opposite entry was in the provision for depreciation account in the debit side, because we are removing the accumulated depreciation for that asset. Then receivables, saying Rahat, the amount is 1350. So now we can balance. The debit side total is 3200, which is greater than the credit side total if you calculate. So 3200, you pass the same amount to the other side and try to calculate the difference, which is 450, and that will be the amount that will be transferred into the income statement. So you will be crediting the disposal account and you will be debiting the income statement. Debit to the income statement means it's an expense. So there was a loss on disposal. And that entry would be made on the 31st of December 2023. With that, we are done with part B. Now we can move on to part C. Part C says complete the table by placing a tick to indicate whether each amount of spending on the new inventory storage space is capital expenditure or revenue expenditure. First, let's try to understand what capital expenditure is. So capital expenditure is the money you spend in order to purchase an asset, specifically a non-current asset, which I should have mentioned in the definition over here. Or you spend money in order to improve the quality of an existing asset, to add value to the asset. Whereas revenue expenditure is the money you spend on day-to-day activities, like buying stocks, paying for rent, things like that. Painting the walls of the storage area, this is a revenue expenditure because this is a cost you incur to maintain an existing asset. Shelving of the storage area, this is more of a long-term commitment, so that falls under capital expenditure. Installation of shelving is also a capital expenditure. Light fittings for storage area is also capital expenditure. So all these three costs fall under capital expenditure because they satisfy the definition of capital expenditure, acquiring an asset or improving the quality. They're more like long-term commitments. So it will lead to long-term benefits. So that's why it falls under capital expenditure. Last one, light bulbs for storage area. It's more like a replacement cost. When you're trying to replace an asset or repair something, that is revenue expenditure. With that, we are done with part C. Next, we are given with some information. We are supposed to calculate ratios. Rate of inventory turnover, current ratio, and liquid ratio. So when you get ratio questions, my advice for you is to write the formula. So then rate of inventory turnover, it's cost of sales divided by average inventory because it's in times. Current ratio is current assets to current liabilities. Liquid or acid test ratio is current assets minus inventory to current liabilities. Now we can go back to the question and try to calculate the figures. So we have to calculate the cost of sales. If you want an extract of the income statement's trading section, you can have it like this. So opening inventory, the question says it's 9,000 inventory at 1st January 2023. purchases 97,000, which is given at the end, and inventory at 31st December 2023, which is the closing inventory, is 12,130. So cost of sales will be opening inventory plus purchases minus closing inventory, and you will get a value of 93,870. So you can use this to calculate the inventory turnover. Right, you can show that like this in the working area, and then you can calculate the average inventory. So average inventory is opening inventory plus closing inventory, that total value divided by 2. So 9,000 is the opening inventory plus closing inventory is 12,130. You add them up and divide it by 2, you will get a value of 10,565. How do you calculate the rate of inventory turnover? It's cost of sales divided by average inventory. So just write that and you will get an answer of 8.88. And don't forget to mention the units. So here it's times. Then current ratio. Let's try to figure out the current assets and current liabilities. Let's go back to the question. When it comes to inventory, we should use the closing inventory because we are trying to calculate the ratio at 31st December 2023. So use the closing inventory, which is 12,130, and closing inventory is a current asset. Then we have receivables, which is a current asset as well. So is cash. But payables is a current liability, and bank overdraft is also a current liability. So we can use these figures. So current assets add up to 18,485, current liabilities 6,140. So let's try to calculate the ratio 18,485 to 6,140. And when you simplify it, you will get a value of 3.01 to 1. Liquid or acid test ratio, it's pretty straightforward. You can use the current asset figure you got previously and deduct the inventory value. So we have calculated the figures before. So it's simply 18,485 minus 12,130. Or else you can just add up 6,180 and 175. And that will give you an answer of 6,355. Current liabilities will be the same, 6,140. When you simplify the values you got, you will get an answer of 1.04 to 1. So with that, we are done with part D as well. Part E is a theory question. It says that Ahmed's rate of inventory turnover for 2023 was lower than for 2022. Suggests two problems which may be caused by Ahmed's lower rate of inventory turnover. So first of all, we should understand what the inventory turnover ratio calculates. What does it measure? The inventory turnover measures the number of times that a business sells and replaces its inventory. So inventory turnover being lower than before means inventory is moving slowly. And that might have some problems. So we are supposed to list two problems. So reduced inventory turnover may be due to overstocking, and this might increase the likelihood of goods becoming obsolete. And that is a wastage cost. It will increase the waste because goods are getting expired or they may be deteriorating, which is a cost for the business. And another problem is another problem of keeping unsold inventory for longer periods is that there will be high storage costs. It will increase the storage and maintenance costs. So these are 2 points that you can mention. So when it comes to questions like this, so this is just a 2-mark question, you simply can write it briefly, but I've explained it over here to make sure that you understand my point. Right, so with that, we are done with that entire question. I hope you enjoyed the video and I hope you understood what we discussed today. Thank you everyone for watching.